Friends, and welcome to today's session on the Taxation Amendment Ordinance. We have learned speakers here, Pradip Kapasi. Before we start, may I request everybody to please rise for the national anthem and institute motto.
Yeshasupteshu jagrati Yeshasupteshu jagrati Kamam 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 Purusho nirvimana Tadeva shukram tadabrahma
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उज्जल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
Thank you. Now, may I request Mr. Amar Bafna to please introduce the speaker. And one announcement, at the specific request of Pradip Bhai, we have not printed the notes. He is very conscious about the environment and has a specific request that please don't print the notes. Thus, please members, we really thank him for this initiative of conservation of the environment. And so thus we have sent the notes on WhatsApp to everybody. Thank you.
A very good morning to all of you. As far as Pradip Kapasi sir is concerned, I think he doesn't need any introduction as far as our CA fraternity is concerned. However, he is a chartered accountant and law graduate from Government Law College. He leads the chartered accountancy firm Pradip Kapasi and Company, which is located in Mumbai. He has been the past president of Bombay Chartered Accountants Society and the Chamber of Tax Consultants also. He has co-authored many professional books like Taxation and Accounting of Shares and Securities, FBT, Search, Seizure, Stamp Duty, etc. etc. He is a regular contributor of articles in professional magazine and various newspaper and magazines such as Economic Times and other leading newspapers, Income Tax Reviews, Chambers Journal. He is also editorial board of Chartered Accountants Journal of ICAI. He has addressed many conferences, seminars for the professionals, tax officials, etc. And today he will enlighten us through the journey of analysis of taxation law amendment ordinance 2019. So friends, please welcome with him loud round of applause. And I request CA LS Lodaji to present him a memento on behalf of our study circle. And I request Pradip Bhai to take us the journey of the analysis of Taxation Law Amendment Ordinance 2019. Pradip Bhai, now.
ये चलेगा ठीक है पॉइंटर यहाँ पे है नहीं थैंक यू सुनिए Good morning to all of you. I thank Mr. Bafna for the kind words of introduction. At the outset, my sincere apologies for being late. The blame is entirely mine. That, as usual, say I am a directionless person, so doesn't understand that where to take turn and where to, how to reach the destination. So it so happened that instead of turning on the right track, I went right up to Goregaon and had to take a U-turn and return to this place. Yeah, sorry for this. Yeah. We are going to today deal with, an ordinance, which gives you a relief, a stupendous relief of about 1,45,000 crores. Yeah, believe me, friends, when I started my practice, the total revenue collection from the direct taxes was just about 60,000 crores. Here now today we are going to talk about a relief, which again in all my years of practice no single relief has given such a major concession in the revenue. So 1,45,000 crores. If you really look at the numbers, you would be amazed to appreciate that it comes to about less than 25% or just about 25% of the total revenue collection from direct taxes, which for the previous year stood at 6 lakh crores. So as compared to that, when the finance minister is so courageous to part with 1,45,000 crores, I do not think that in all my 30 years of plus practice, I have come across a relief which would give you, a concession in such a large number. You would always have a relief of about 8,000 crores, 10,000 crores, but not 1,45,000 crores. And mind you that this is one relief which the quantum which I am narrating is about for assessment year 2021 alone. And when you look at the relief which is likely to continue and overflow into the subsequent years, then it would be a terrific concession. So it really requires either you have to be a very courageous finance minister, or you could be a very stupid finance minister, in the sense that you have this budgetary deficit which you need to control. The economy does require that relief, the concessions were required perhaps, but of this magnitude one doesn't know. So I just wish her good luck that years that what courage she has shown translates finally into the benefit for the government as also for the taxpayers, that is the company. There is another school of thought which feels that that there is this relief, instead of being given to the corporates, could have been passed on directly to the shareholders, that is to individuals and the taxpayers other than the companies. But maybe a lot of thought must have gone into it, and then we would have perhaps had a different school of thought we could have followed. For the purposes of our discussion, in order to make it more meaningful, say I have tried to present it in a manner which is more suitable, which will first take you to the new provisions of BAA and BBA. Then there are some common issues. See, the issues are normally common, to any discussion on tax laws, and therefore we would discuss few common issues, and there are other issues while we would discuss. Then we would also touch upon the provisions of MAT. Yes, please come. Then there is some amendment relating to buyback of shares, an important amendment. Then what would be the position in relation to the rates of tax and the surcharge subsequent to this ordinance? We'll try to analyze the impact of that. Usually what happens is when a finance bill is being passed, all of us discuss finance bill in detail, but then there are small prints when it is enacted, and when in between there is a gap between the cup and the lip, and this is what is, there are some important amendments which are carried out while enacting the finance bill. Time permitting, I will touch upon that. Then there have been some few important amendments in relation to money laundering and also in relation to Benami properties. I'll just brief you on that, once again permitting the time. I am late and I'm responsible for that. So we'll try to speed it up and try to close at least latest by 11 o'clock. Let's see whether we can achieve or not. My presence is here today is singularly attributed to my dear friend Atul Mathuria, who has been a friend of a long time, and has been, pestering me to come over here, and for one reason or another, my apologies again that I have not been able to make it. I am conscious of the fact that you perhaps are one of the largest study circle all over the country. Your size of membership is larger than many of the branches put together. So therefore you could perhaps be an independent branch by yourself. And I am glad to stand before you for this. I would just brief you about, what has been the present state of rate of taxation. The story today is more about rate of taxation, the surcharge and the related MAT provisions. So we'll try to understand that presently there are 3 prescriptions that you are permitted for assessment year 1920, for which you must have almost filed the return, but for transfer pricing reasons, returns. So basically you have an option under 115BA, which is an option which is on since AY 1617. So if you opt for 115BA, then it was an attractive concession that you pay taxes at the rate of 25%. If you don't opt for that, then you pay the taxes under the first schedule, and depending upon the turnover for 17-18 financial year, you pay tax either at 25%, and if your turnover is more than 250 crores, you pay tax at the rate of 30%. In addition, you do pay surcharge if your income is exceeding, this is all about corporates, and that to domestic companies, that if your income exceeds 1 crore of rupees, you pay 7%. If it exceeds, this is surcharge. If your income is exceeding 10 crores of rupees, you pay 12% of it. And up to an income of 1 crore, you don't pay any surcharge. This is the position it was for assessment year 1920. There was a flat rate education cess of 4% that was leviable before surcharge. Then you had effect, so therefore the effective rate was somewhere in the range of 26% and up to 35%. So this was, the story was between 26 to 35%, and if you were otherwise not liable to pay this tax, then there was a book profit tax known as a minimum alternative tax, which was in the range, which was 18.5% flat plus the surcharge and the education cess. This is what has been the position as far as the tax rates are concerned for AY 1920. Now comes the ordinance. The tax law amendment ordinance is enacted. It was proposed by the finance minister and has been promulgated by the President of India on 28th September 2019, and it has come into force with immediate effect. Usually, any amendment is prospective unless otherwise stated. However, in this case, though it is not retrospective, but it would surely be retroactive because it will apply to the entire assessment year 2021. It would apply to entire assessment year 2021. So, on the basis of the previous rates as were pronounced by the first schedule in the Finance Act, if you had paid advance tax, then it should have matched a higher amount. For the reason, for the first and second installment, you were required to pay tax at the rate of 30% or 25%. But under this amendment, now different rates are prescribed, namely 22% or 17%. So even if there was a shortfall for first installment or second installment, you would not be subjected to 234C interest, simply for the reason that these rates would be considered to be retroactive and would apply to the entire fiscal and assessment year 2021. This power is derived by the President under Article 123 of the Constitution of India, and as I said, it has been notified also on the very same day. The shelf life of any ordinance, under the Constitution is maximum period of 6 months. So with expiry of 6 months, that is on 19th of March 2020, this ordinance would become ineffective. So either the Parliament is required to pass a new law by amending the Finance Act and also the Income Tax Act, or in the alternative, it will have to promulgate once again another ordinance. I would believe that that by this time Finance Bill 2020 would come, and this ordinance would then be incorporated in the Income Tax Act. There has been a corrigendum which has been issued within 6 days, which explains that that homework is required to be carried out very precisely, which it was not carried out, and some slip which was made in the ordinance is sought to be corrected. I'll explain to you later on. There is a mistake here when I refer to circular. Here is not circular number 25, it is circular number 29. Once again, apologies. Which again, explains that, back to back you have to come out with explanation which you could have taken care of while enacting the ordinance itself. We would first deal with the first major amendment, which is known as Section 115 BAA. You already have Section 115 BA, which has cast an option, with effect from assessment year 16-17. Now you have another option which comes under the same alphabets, BAA. Now BAA. This is essentially a provision which grants you a very handsome concession, but as usual, terms and conditions apply. So it comes with the package of conditions, each of which we will try to understand. These amendments are not something, which are complex, but if we slip somewhere in understanding, then in that case, we perhaps would have missed the bus, and the major concession which is sought to be provided perhaps would not be granted. So therefore, my advice to you would be to follow the conditions carefully. This benefit of or the concession is available only to a domestic company. So you need to be a company and you need to be a domestic company too. If you are a foreign company, you are not entitled to claim this. If you can't be classified as a domestic company, you are not entitled to claim this. 2 subsection 22 capital A provides for the definition of domestic company. For the purposes of our discussion, it would be sufficient that we take it that an Indian company, a company which is registered under the Companies Act of 2013 or the previous 156, is a domestic company for the purposes of assessment. So this is one thing that it is entitled, you are entitled provided you are a company and a domestic company. The provision has an overriding effect. It overrides all other relevant provisions of the Income Tax Act. one would just notice that an overriding effect is far reaching, but I would believe that we would try to understand that it cannot override other computation provisions, assessment provisions, appellate provisions, and so many things, including the payment of taxes provisions. So to that extent, one would believe that there is yet again slip, that when it overrides all the provisions of the Income Tax Act, one would believe that the overreaching would be restricted to the provisions which provide for computation of tax and not even computation of total income. As far as taxes are concerned, yes, the rates of taxes are concerned, care has been taken in the ordinance to ensure that it overrides the provisions. It overrides the provisions of Chapter 12, but does not override the provisions of 115BA and BBA, which both of which we will discuss. So to that extent, they are mutually exclusive. So we will keep this in mind for the limited. But Chapter 12 is important for the reason that Chapter 12, as you are aware, also houses the provisions like 111A, 112, 112A, which provides for the rates of taxation in respect of special categories of income, namely capital gains. So that is not overridden, and therefore it would continue to apply. So if you are eligible for some further concession, in my opinion, you will claim that benefit of a further concession. So what is the benefit which is being provided? Good morning. Under this 115BAA, the singular benefit which comes for our benefit is that my total income, the total income of a domestic company would be taxed at the rate of 22%. Will be taxed at 22% as against the present rate of 25%, as we noticed in the second slide, or 30% when our turnover exceeds 250 crores or 400 crores now for assessment year 2021. So there is a concession of minimum 3% or maximum 35%. So which we will keep in mind. But again, as I said, it comes with a baggage, and the baggage is in the form of a flat surcharge. The surcharge which is payable in the earlier case which we noticed was up to 1 crore of income, you do not pay any surcharge in respect of these corporates. However, if you opt for this 115BAA, then in that case there will be a flat surcharge payable from rupee 1 of 10%. And it is here that the benefit which otherwise is attractive becomes lesser attractive. We'll see overall impact, but at this place, this flat surcharge someday, if it goes away, then the benefit would be really absolute. It will have some meaning. The effect, and there is education cess which applies to everybody, is 4%, which also includes secondary education cess. So this effective rate, that is of 4%. The effective tax rate would be 25.16%. Would be 25.16%. What is not relevant under BAA is your turnover is no more relevant. Whether you have 400 crores or you are less than 400 crores, then of course you have 25%. But here you will get 22%. And even if you have turnover which exceeds 400 crores, you will not fall under the 30% bracket. You will still be able to enjoy 22%. This is warming up in the sense that that I'm trying to hammer down few things by repeating it for the reason that it is, once we understand, then the flow would be quicker. Turnover is not relevant. There is another concession which is a major concession, is that you would, once you opt for BAA, you would never be subjected to MAT for that particular year. So this is a major concession. There is no MAT. Of course, you would pay this provided you are otherwise liable to pay. The important implication of MAT concession is that 22% rate of concession is given to you on the assumption that you will not claim certain benefits, which is good. When you give up certain benefits, say you might lose on certain taxes. So when you pay more taxes, then the government is happy otherwise. But important thing is that even without claiming those deductions, if you are otherwise your income is lesser than what is otherwise a book profit, then you will pay tax at 22% only on such reduced income. And it is here that in ordinary circumstances up to 1920 you were otherwise, you could have been liable to MAT, and which was 18.5%, which now you would not have to pay. So this I would believe is also incidental but a substantial concession. The concession is not automatic. You need to seek that concession. You need to opt for that concession. You need to apply for that concession. And that application will have to be in the prescribed manner. A form would be prescribed and which is required to be exercised, on or before the due date of filing the return of income under section 139(1). So therefore you need to be careful that if you advise your client to go for this benefit, then make sure that the option is exercised for claiming benefit under BAA before the prescribed manner, and it could be exercised for any previous year. For some reason, if you miss the bus for say AY 2021, then in that case you can still go for AY 21-22 as far as this BAA is concerned. This is materially different than the next concession which we are going to take care of. So please keep that in mind, that this is not something whereunder, if you miss the bus, you can always catch the bus at a next platform, next station. The reason behind that is that, that there is a concern that, this provision does not allow you to claim set off of the carried forward losses. It doesn't allow you to claim the set off of the unabsorbed additional depreciation. So a concern had been raised that in such cases, should it not be proper that yes, that I should first be allowed to set it off? Then in that case, the response of the government is that if you so feel, please do not exercise this option for this year. Try to come through this window in the following year, which makes sense. But once you exercise the option, you stay put and you stay committed to that option. If you have exercised it for 2021, for 21-22 also, you will be covered by BAA. You can't opt out of it. That is something which is not thought of by the government. There could be serious implications on account of this. But right now, as the law is, let's appreciate that I can't get out of it. Then I will be stuck with 22% unless the rates are changed. By an amendment in this provision, not in the Finance Act, in the provision itself. This is something you will have to mull about, think about it, and before you opt for it, you should be clear about it. So withdrawal is not possible. It's like a marriage, once you have married a person, you stay in the marriage. You can't get out of it. So therefore be careful about it as well. As I said, the turnover is not relevant, and presently if you are covered by BA companies, that is 115 BA going for 25%, there is a handsome provision which provides that you can shift from BA to BAA. Now, which is a good concession. The government has therefore thought about it, that those companies which have opted graciously for 25% concession, now that 22% is available to some of the other companies, why should they not opt for this? And therefore this provision is permitted, which is a transition from BA to BAA, and I would believe that that is a good thing which has happened. Benefit, as I said, is that it comes with host of conditions, and what are those conditions? Let's see that. The first and the foremost condition which is provided for is that you will not claim certain benefits of exemptions, certain expenditures, and certain losses. You will also not claim benefit of certain deductions under Chapter 6A. So therefore, and what are they? One is 10AA, that is SEZ related exemption. Then chapter 6A deduction you will not claim. Normally income related exemptions are being enjoyed by corporates. So these income related exemptions are placed in part C of chapter 6A. It is part C which would not be entitled, but if you have payment related deductions like donation, ATG, ATGGA and such other things, you are welcome to claim that. As far as part C is concerned, the singular exception which has been made is in relation to ATJJA. That is when you make payments to your workers who are new workers, then you get a weighted deduction, which is a hefty deduction. You can continue to claim that deduction. That deduction is not denied. Then there are deductions relating to the plantation activities. Then there are deductions relating to scientific research expenditure and so on. We will later on take this up just for the reference. Another important amendment, important condition is that you cannot claim the set-off of losses of the earlier years. You cannot claim the set-off of losses of the earlier years. So when you opt for this, make a calculation. First try to absorb your losses and thereafter move to the new option. What is important as far as this condition is concerned, that it is not something which would bite you a lot, for the reason that you have to carry out an independent exercise of the losses which is being carried forward to find out that how much of these losses are attributable to these provisions. If the losses are not attributable to any of these provisions, now I can't see that there could be a losses attributable to 10AA or chapter 6A, which are the major concessions. So if your losses are attributable only to some of the other provisions, mainly additional depreciation or some of the other deductions which have been given, then only such losses will not be carried forward to be set off. Otherwise, you would be able to carry it forward. That is a good thing. Third condition is that claiming of depreciation otherwise under section 32 is mandatory. You cannot simply say that I will pay tax at a lesser rate, at a concession rate, but I will not claim depreciation because in some manner it suits you. That is not done. It is not permitted. The depreciation claim is mandatory and therefore your computation will have to claim this depreciation other than the carried forward additional depreciation. Then the losses which you have for assessment year 2021, that is assuming that you are opting for this concession, then the losses which you will have for assessment year 2021, now this is something substantial, is that will be deemed to have been set off, will be deemed to have been absorbed, and therefore they would not be allowed to be carried forward to the subsequent years. A doubt arises here in my mind that if my losses are attributable to some of the prescribed provisions, I'm good. But if my losses are otherwise in relation to some other provisions, then should it not be that that I should be allowed to carry it forward to the subsequent years and set it off? My personal and a professionally considered view would be that I should be allowed and I should not be denied the benefit of carry forward of such losses which are not attributed to this. You have prescribed that these are the provisions, I should not claim the benefit under these deductions or exemptions. I would not claim. But if I have genuine business losses, operating losses, I cannot be denied to carry forward. This would mean, to give you an example, that a company has ended an year with operating losses of about say 2 crores of rupees. Now in the next year, say if it has a profit of 3 crores, I would take it that yes, that those 2 crores which has otherwise not enjoyed any concession should be entitled. Howsoever, that circular 29 which I referred to of 2nd October 2019 seems to be suggesting that yes, that losses are not allowed to be carried forward. I believe that there is no blanket exemption from carry forward. It is such losses which is attributable to these provisions should be. A care has been taken when prescribing the condition number 2, that the carried forward losses of AY 1920 and earlier years to the extent attributable to these provisions would not be allowed to be set fair. So I would believe the same understanding I should be entitled to carry it further for the other losses too also. This is something you will have to think about it. You know that, and my view therefore I say this, that other unspecified losses would continue to be allowed to be carried forward. I think that there should not have been any debate on this aspect, but a different professional view is prevailing, and I considered it my bounden duty to place it before you, that yes, my personal view is that it should be allowed to be carried forward. As far as these benefits and deductions are concerned, rightly so, they would be deemed to be set off. They will deem to have been claimed and set off. So therefore, there is no overflow of these unclaimed benefits to the subsequent years. You would not be in a position to say that 80IA or 80IB benefit or 80IC benefit should be computed by assuming that they were not claimed. Though they were not allowed, but they will be deemed to have been claimed. So this is also a major thing. As it unfolds, it will grow on you. You will realize that this is not a simple amendment which simply changes the rate of taxation. There are several conditions and several understandings which will have to be derived out of it. So please keep this in mind. What is irrelevant? What is irrelevant and which is relevant for our understanding is that whatever business the domestic company is in, whether it is service, whether it is job work, whether it is NBFC or any business, it's not relevant. All of you are welcome to get into this window of 22%. Whether you are in a manufacturer, whether you are a manufacturing domestic company or not is not relevant, which is relevant for the subsequent amendment. But for this it is not relevant. So what the point which I am trying to hammer down is that everyone and anyone is entitled to get into this for this concession. This is important. While we come to the other provision, there are serious restrictions. So therefore, as far as this is concerned, you will come to do this. Date of setting up is not important. You might be a company which has been set up in the year 1950. You can apply opt for this amendment. Good. Turnover, I am repeatedly saying, is not relevant. Composition of head of income is again not relevant. What is the composition of your head of income is not relevant. You are a company, a domestic company incorporated in any year, and has income only under the head income from other sources, you can opt for 22%. So this is, so existing companies are eligible. According to a back-end calculation, see the minimum benefit would be 0.83% and the maximum would be 3.95%. This is on the assumption that you are not a company who has a turnover of 400 crores or more, and you are not a company whose income is exceeding 10 crores of rupees. If you satisfy those two things, then your benefit could be as high as perhaps 9.77%. You will gain in the range of, even by opting for this 22%, which is way above 15%, you will still gain around 10%, which is 28% of your total taxes which you would otherwise be paying. So there is a very handsome, hefty and substantial concession which is sought to be given, which is 28% of the tax which you had paid otherwise for AY 1920. This would happen in case of a company who has a turnover and who also has the prescribed income. But even if it is not so, you would gain somewhere in the range of 4%, which again in this tough period is not something which is bad actually. So this you would keep in mind. But having said that, the finance minister in the previous statistics had told us that the companies who have turnover exceeding 4 crores and who have income of more than 10 crores, are less than 1%, that is just about 0.7%. And if you consider the total companies registered with ROC or Ministry of Corporate Affairs, they are just about 8,500 companies. So for them, this benefit could be huge one for them. And if you consider the total corporate tax which is contributed by these companies, it is about 30% of the total corporate revenue collected. So therefore, it is good that these companies would have a good benefit on this. Circular number 29 has clarified a doubt that the unabsorbed depreciation pertaining to FY 19, 20 or earlier years, if that depreciation happens to be additional depreciation, then that is lost. I don't think there is any doubt about it, but that is lost forever. You will not be able to opt for it even when you get out of this provision, if possible, if it is possible to get out. Importantly, the benefit of the further concessional rate in respect of the long-term capital gains or short-term capital gains on specified securities, which are they? That is equity shares, then the equity oriented funds, that is units of EOF, and this otherwise this FII benefits, which includes derivatives also, and the units of the business trust. In respect of these 4 categories, if you are enjoying a special rate of taxation, which you would be, which is less than 22%, which in some cases would be 15%, which in some cases would be 10%. Now, in such cases, this benefit would continue. Even though you have opted for this benefit, you will still pay taxes at the lower rate than even 22%. Then we move on to the next provision. This next provision is tailored or modeled on the similar lines, but which has some major differences. So we'll try to understand that what is this provision. This again, like the previous prescription. Yes, thank you. This again, like the previous provision, is effective from 2021. It grants you a handsome concession in terms of rate of taxation, and it is restricted to domestic companies. These 3 things are fine. They are same as they were. The 4th one also, the overriding effect is also same, and therefore we will not discuss that. The important difference, number 1, is that under the old provision, the tax rate was 22%, and here it is 15%. Here it is 15%. Now when you compare it with present 25% or 30%, you have a concession of almost 50% or more than that. If you are paying 30%, 50%, 25%, little lesser than that. It's available to, once again, a domestic company. And the major difference, second difference, is that you should be a domestic company which is engaged in the business of manufacturing or production. You are engaged in the business of manufacturing or production. The term manufacturing is something which we are familiar with because it is defined in 2 subsection 29 capital B. Production is not defined, and therefore what it would mean is something we would try to understand later on. Surcharge would be at flat rate of 10%, which is obnoxious in my mind. Someday it should go, and then this benefit will be a great benefit. Education cess of 4% would also remain. The effective take rate therefore is 17.16%. 17.16%. Even when you compare it with even the previous provision which we discussed, there is a difference of about 8%, more than 8%. So this is the effective rate. Turnover again is not relevant, which is common as it was, and there is an exemption from MAT, which also we discussed, like as it was in the previous this thing. This is also subject to exercising an option. You are required to exercise an option in a prescribed manner by the due date, which is all good, same as what we have already discussed. But here, though the term says for any previous year, I would believe that it is some kind of a miss or a misnomer, for the reason that, as we will understand later on, that it would not be possible for you to exercise it in any previous year. There will be a fixed mandated previous year for which only you will be able to do this. Once you have exercised it like the previous one, it is automatic. You don't have to do it year after year, and the withdrawal that is not possible. Turnover of more than 400 crores also is, such companies also are eligible here. And one would believe that it is not possible for existing company. The existing companies, the companies which were in existence up to 31st March 2019 are by a stroke of pen made disentitled, ineligible for claiming this. That's why I said, when we understand the related condition, that it's not for all companies. One, we have understood, even if you are a domestic company, it is possible only when you are a company which is manufacturing company or a producing company. So this also we would keep in mind. Like the previous one, it is a conditional benefit, and here there are more number of conditions. Some are common, which we will avoid repeating, but just take a note of it. Is the first condition, which is uncommon and different, is that that your company, which is a domestic company, a manufacturing company, a production company, is required to be set up and registered, and which should commence manufacturing during a period commencing from 1st October 2019 and ending with 31st March 2023. So this window is open for limited number of years. What is important for us is that we have understood that the existing companies are not eligible. That would mean that if we want to enjoy this concession, which we should try and endeavor, then in that case you need a company which is set up. You need a company which is set up on or after 110. You should start thinking on these lines. You need a new company which is not only set up but which is registered after 110, and which should commence manufacturing. Which should commence manufacturing on or after that date, not before that date. So these three conditions are paramount for the purposes of claiming this deduction. So we will keep that in mind. The other uncommon condition, which is also a new condition for this BBA, is that the new company, you would be easy to form. You would be in a position to advise that, yes, please form a new company, let's start manufacturing in the new company and disband the manufacturing which has been so far carried out in the old company. Is that possible or not? It is something which you should seriously think about, because the second condition provides that any company or any business which is formed, any company or any business which is formed by splitting up the existing business, not the company, splitting up the existing business or reconstruction of an existing business, then in such case you would not be entitled to claim this. So this whole exercise, whole adventure of forming a new company will be made to naught if you are not careful, and if the government is able to pounce on you by saying that this is a split up or a reconstruction. So please don't do so. You would wish to sit here, there is a place here. Yeah. So this splitting up or reconstruction is something on which each of you could write a doctorate. In the sense, it has been there since ages, since the Act of 1922. There has always been this concern with the government that if you form multiple companies, then in that case, just to claim benefits, you will not be getting. The all important decision, if you read one decision, you will have to not read any other decision, and that is tax macros decision. Textiles Manufacturing Company Limited. It's a beautiful decision which answers all your questions relating to what is split up, what is not a split up, what is reconstruction, where you could be getting out of the difficulty of reconstruction. So if you read this, there would not be a difficulty. So please try to look into that. There is an exception which is statutorily provided in the amendment itself, and it is granted in relation to those companies which are required to be rehabilitated. If you are an existing company which had been on account of natural calamities, you have been destroyed, and then you have been rehabilitated, and that rehabilitation classifies to be the one under section 33 capital B, then in such case you don't need to worry, then you can surely shift to this benefit of 15%. So those companies which have been into those areas, like Orissa, Tamil Nadu, Andhra Pradesh, which has been devastated on account of the floods, or some of the places on account of earthquake, then in such cases there would be a possibility to opt for this, and for such companies this could be a major benefit. The third condition, which again is a new condition and not common to the old one, is that here you are not allowed to use the old plant and machinery. You are not allowed to use the old plant and machinery. Two exceptions are made here. So what we have understood is that if you are using old plant and machinery, whosoever has used it, this is not assessee specific. This is not assessee specific. I would believe that this is machinery specific. And therefore anything which is second hand, if you are using it, then it would not be new in your hands. So keep that in mind. But there are two exceptions and welcome exceptions. If you have imported plant and machinery, which are not used in India, in respect of which no Indian has claimed a benefit of depreciation, and the machineries which were lying overseas were not owned by the same company, then in such case, such an import of plant and machinery, even if it constitutes 100% of your plant and machinery, would be outside the restriction, and you can do so. But important thing is that it should not have been used overseas by the same body, and no depreciation should have been claimed even by anybody else in India. If you satisfy these conditions, there should not be a difficulty. The another important exemption, which is a practical exception, is that you can use old plant and machinery, you can buy old plant and machinery, provided the value of such plant and machinery constitute 20% or less than 20% in respect of these. So please check this 20%. I would believe up to 20% is excluded. Anything over and above 20%, then you will not get deduction at all. You will not get this benefit at all. Which similar provision is already existing in 80IB, 80IC also. So there is yet another uncommon condition, is that if you are using a building which is old, then in that case you need to check up whether such a building was ever used for the purposes of hotel or a convention center. If it was ever used, then in that case, such a building if you are using, even though it was not owned by you, I am afraid that in such case you will lose the concession. So please try to take care of this. This is not an assessee specific thing. Howsoever, if that hotel has been remodeled or demolished, then in that case there would not be any issue on that. Then the common conditions which are there is that you would not claim this host of deductions, expenditures or exemptions which we have discussed in detail. Yes, the new condition is that business should be that of manufacturing and production of article or things, which we have understood, but it should be manufacturing or production of article or things. So something which cannot be classified as article or thing, because in the past there have been debates on such things also. Whether an intangible right could ever be considered as a thing, the courts are divided on it. So therefore please apply your mind to this, that you need to be manufacturer. You need to have commenced manufacturing after 110, on or after 110/2019, and you should be producing article or thing. And which is a conjunction which says you should either be in the business of research in relation to the manufacturing or production. So this also is a condition which is attached to the manufacturing or production. Or not every company who is manufacturing would be in research. So therefore there is a handicap, a serious handicap, but a care has been taken to provide either in research or in distribution and selling of the article or things which you are manufacturing. If you're manufacturing this, it's fine, but you should also be distributing this. Along with that, if I'm distributing this, I perhaps would not get the concession. Be careful, most of these companies do so. If you're manufacturing, safety razors, you are welcome to do so. But you are buying safety razors also, and also selling them under your brand only, there could be a serious difficulty. Not everybody would get into this, so please treat. So either a distribution is necessary or a research is necessary. Either a distribution is necessary or research is necessary. Keep that in mind. I would take it that that the compliance is cumulative as far as the condition of research or the distribution is concerned. It is not a disjointed thing. Most of the thinking which has developed over this, is normally that one believes that if you are manufacturing and if it qualifies, you will be entitled to. I would take it that it would not be so simple. You will have to establish that what I am manufacturing is also distributed by me. Why I am repeating this is that many of us are manufacturers, but we are not distributing the product which we manufacture. Can you envisage where could it be? Where could be such a situation? Very well said, yes. So in cases of job work, you will be out. You will be out of this window that you are manufacturing but not distributing. So you will have to be careful. In the past, under Chapter 6A, the position has been that even if you are a job worker, but if you have plant and machinery, if you have factory, you could still be a manufacturer, which you would continue to be, but not for the purposes of this benefit. You would be a manufacturer who is not qualifying for the concession. So keep that in mind. This is my view. Second and important thing is, and this is very strange, is that the section requires, the provision requires that you should be exclusively engaged in the business of manufacture or production of article or thing and distribution or research. So if you are unexclusively engaged in this, and if it is not the only business which you are having, then in such cases I am afraid there could be a serious difficulty. I would believe that that this issue has to be looked at from multiple angles. The first is that that I am a manufacturer, I am otherwise a subsidiary of a foreign company. I am manufacturing my local brand and marketing it, I am qualified. But I am also promoting the brand of my foreign company, my principal, and I am deriving some business income on account of it. Perhaps here there would be a difficulty. Same can happen even with the Indian companies holding subsidiary companies. So your composition of business income will have to be viewed microscopically in order to come to a conclusion that my income constitutes the income which is derived from manufacturing or production by me, and which article or thing which I have produced are marketed, distributed by me. And I have no other income. I have no other business income. Would this be different when I have some income under some other head of income, which that also we will talk about. Then the usual conditions of not claiming the set-off of losses, the issues surrounding set-off would be same as we have already examined and discussed, and my view is and our view on that is shared. Same is issue about mandatory requirement of claiming depreciation. Please keep that in mind. The specified losses, would be deemed to have been set off, and it should be restricted to specified losses and not other losses, is something which we have discussed. And the deductions would be deemed to have been claimed and set off, that also we have discussed. The new condition next is that the AO here is empowered. He is vested with a power to compute your income, to recompute your income, and grant deduction or concession in respect of a part of income, and perhaps deny the concession in respect of other part of income. How we will do, I do not know, because the law does not prescribe the computation in such cases. But what is provided is that if my affairs of business are so arranged, and is carried out with my close associates or even outsiders, if the arrangement facilitates, this is important, if the arrangement facilitates for me to write higher profits, for me to record higher profits, for me to have higher income, because I am eligible for concession, then in such case he has a power to rewrite my books. He has a power to rewrite my books and determine that profit which satisfy all conditions and which is not inflated profit. Are we clear on this? That if my profits which otherwise would have been 6 crores of rupees is so doctored that I am recording a book profit of 7.5 crores and claiming 15% tax rate in respect of that benefit, then in that case I am afraid that I would be entitled to claim the benefit for 6 crores of rupees and would not be entitled to claim the benefit for the rest of 1.5 crores of rupees. So it is also provided that if I have transactions with my associated enterprises, which is a transfer pricing provisions, and the transactions are not at arm's length, and those associates are domestic associates, then even in such cases the provisions of ALP would apply in one of the prescribed 4 methods or otherwise any of the permitted methods. Subject to the safe harbor provisions, I will have to comply with the ALP provisions, I will have to maintain records, I will have to obtain the audit report, and also ensure that the returns are filed within the time permitted otherwise. So this is something which is special to this benefit. We will keep it in mind. The benefit of concessional rate of 111A and 112A is retained here and is not overridden. We will keep that in mind. As I had been hammering down is that you look at the benefit, you would have otherwise paid the taxes at 34.94%, which is almost 35%. You would now pay tax only at 17.16%. So there is a great attraction to productive companies. Those companies which otherwise pay huge taxes, for them, it is not only good for them to think of diversification or think of manufacturing in some other manner. As far as you fit your case, into Taxmaco's case, that should not be a difficulty. if you can excuse your case, see out of the reconstruction and splitting up, and if you can constitute a new company and satisfy other conditions otherwise, this is a good benefit. Consequences of non-compliances, because as I said, this is a provision which allows you to enter but no exit is provided. But it also provides for the computation of ALP and the power of the AO. So therefore one would believe that for some reason, if you are unable to comply with some of the conditions, then in such case what would happen is, I could think of some case wherein say some deduction which I should not be claiming I have claimed. So what AO can do is perhaps he can disallow that claim, but I would still remain within the window. I'll still remain within the window, and therefore I can't think of something wherein say that if I don't comply my benefit would be withdrawn. It could be reduced, that I agree, but how would it be withdrawn? This can be withdrawn only that, and that is where that when I stop manufacturing, when I stop producing, when I have my business income constitutes income from some other business. Now in such cases a serious challenge which will arise, which has not been thought of or perhaps is not provided for, that in such cases the issue would be that would I still pay tax on 17.16% in respect of income which is otherwise the one in respect of which I have satisfied all other conditions. So it is my non-satisfactory income that only should be excluded, and I would believe that should be the rational view. That should be the rational view. But the way the law is provided, it perhaps gives me an impression that I would not enjoy the benefit at all in the second year, third year or fourth year. I would not like to take such a view. I believe that in respect of such income, once having entered, because you have obstructed my exit, you are not permitting me to exit. Now if that is so, then allow me to remain within the window and enjoy the concession in respect of that income which satisfies all the conditions, and I will be paying taxes at the 30% or whatsoever, in respect of my other income. This is the way the law will have to be read. According to me, perhaps will have to be read down. And the classic example which I can think of is that all of you who have looked into 80IB 10, erstwhile 80IB 10 and now 80IBA, which grants you a good deduction in respect of the income from development of housing project. In such cases, the issues often used to arise that there is one wing which is satisfying all the conditions and there is another wing which does not satisfy the conditions. There are some flats which are exceeding in size and there are some which are not exceeding in size. Then in such case, should I lose the benefit altogether? And the government of India was of a view that I will be denied the benefit. But the courts are of the view that the benefit will be given to you, but to the extent the profit which is attributable to those flats or that wing which is satisfying the conditions. I think that this is this provision which should be brought into play here. If I am exceeding time, you can tell me when. At least tell me 20 minutes before that, so that there is no issue. Yeah. Yeah. So here, that one option was that if you permit me to think in this manner, wherein see that it is possible for me to split my profits in two parts, then the question that would arise for consideration is that if I don't satisfy this condition, would I go into the previous provision, that is BAA, or will I be spun off altogether and will get into 30% bracket? When I look into BAA, I see that that whether I am satisfying all conditions, the answer is yes, that I am a domestic company. which has no condition as regards the composition of income. It has no condition as regards the production, manufacturing or distribution. So therefore, in such case, the better view would be that there would be a transition in respect of part of income which will be covered by BAA and the another part which will be covered by BBA. That should be the correct reading of the provision. As the time unfolds, perhaps the government would be forced to clarify this, or the courts will clarify this. So there is nothing like auto withdrawal. What I mean is there is nothing like auto withdrawal. Yes, unless I violate all the conditions, then that would be possible. The power of favor we have discussed. Yes. Relevance of research or distribution, I have said that one of it is essential. If both are absent, you may not get into this. Non-manufacturing income, I have explained. There would be related income. Even if I am in exclusive manufacturing or production, there are income which are related to this. These are incidental, which are necessary for me to carry out this activity. And what are those income? I am providing some services. I am providing after sales services. There are annual maintenance contract. In cases of the companies which are in the manufacturing of aircrafts or the vessels, the after sales service or the AMCs constitute the large things. Those who are in ERP and other things, the AMCs only constitute the major income. Sometimes these companies don't earn anything on production. They earn on account of the supply of spare parts and other things. So it is in such cases, there is a concern. It's the service which I am providing cannot be attributable to distribution of the and production of article or thing. So there is a concern, see, someday somebody will have to apply his mind. If a strictest view is taken, then I am outside the window. So part of that income should not be eligible for concession. If a liberal view is taken, which should be taken, and I don't see no reason why it should not be, because such income also should be considered to be country related to or attributable to manufacturing. Had I not been in manufacturing, I would not be getting this income. So please keep that in mind. If I have income under other heads of income, my view is clear that there will be a difficulty. But if you have interest income which you could be associated and could be considered as incidental to carrying on business, like you take bank guarantees or you take fixed deposits, and in such cases the deposits are required for the purposes of obtaining the credit facilities, courts have on and off taken views which are contradictory. So you are welcome to take your view, but other than that, an income which is strictly taxable under other head of income, there is a difficulty. And such income could be an exempt income also. Like if you are in receipt of a dividend income, mind you, see, I am not a person who will raise troubles, but it's my job to shoot troubles for your kind consideration, that unless you understand and handle this, there is a problem. So if that dividend income, even though if it is not taxable, if it is not considered to be on account of the income which is derived here, there is a problem unless a clarification is given. Then there are usual conflicts in relation to all such income, whether you are a producer or not, because it is a term which is not defined. If I am in the business of processing, could it be considered as production or manufacturing? Courts are divided. Job work, whether it is eligible, my view is that if I am in pure job work and if I have no production which is distributed, I am out of it. But I am incidental job work, there are incidental receipts, there is a possibility of getting it. Yeah, thank you so much. But the point is that I don't know when 10:45 will happen. So just let me know. That's what it is. Yes. So if there is outsourcing, even in such cases, see, could it be considered as a manufacturing? My view would be yes. That when I'm getting my articles produced out by outsourcing it, a part of it, and I'm doing the final thing, and I'm distributing it, my view would be I would be entitled to. But if I'm doing it on job work basis, that is my business, then there is a problem. So I have distinguished the job work from outsourcing. Outsourcing possible, job work not possible. Then when you produce power, whether it would be electricity is a manufacturing or production, there is an ongoing debate, and that is why in ATIA 4 power is considered to be a separate industry. So therefore that there is a need to clarify that too also. Then blending, you are in the business of blending many things, see, you blend tea, you blend perfumes, see, so many other things. Could it be considered as manufacturing? Against the mixed and a divided view. Same would be for mixing food, whether it is production or not. There are court decisions which hold it to be manufacturing. There are court decisions which consider that food is not a manufacturing and not production, so there is a problem. Same is about mineral water or filtered water also. Infrastructure, you have the famous NC Buddharaja's case, Supreme Court, which says that construction of dams and such roads is not a manufacturing. So I would go by that decision. But these days you have different kinds of infrastructure, so therefore some may happen, some may not. If I am a contractor, then ATIB, ATIC, ATIA provide that contractor is not eligible. But a specific provision is included there. In 115 BBA, there is no such provision. But the conservative view, perhaps a correct view, would be that a contractor who is not in the business of distribution, then in that case there is a problem. A contractor who is producing and selling his goods, yes, but not otherwise. Which are these exemptions and deductions? As the time is running out, please go through this. I have carefully defined each of them. Look into those provisions. Don't overlook any of them. You might make a mistake by overlooking. What are the common issues? Issues which are common to both the provisions. One is Chapter 12 I have already discussed. It is overriding Income Tax Act. I would say no, it cannot override the Income Tax Act. It will override only the provisions which prescribe the rates of taxation. It's very ambitious when it says that notwithstanding any of the provisions of Income Tax Act, it's not done. Why these such things are being brought before everybody is being discussed in such conferences is that you have parallel provisions elsewhere wherein a care has been taken to say that I am not overriding all provisions of Income Tax Act. Like if you see the provisions of special provisions relating to assessment, 153A, 153B, 153C and D. In all 153D and 153A, E. In all such provisions, a care has been taken that I am overriding, but I am overriding these provisions only. But here, notwithstanding everything, which is very ambitious, that I would take a view, perhaps it's a correct view, that wherever under DTAA, if the domestic company is required to pay taxes at a lower rate, like what is in respect of 111A or 112A, then in such case, the provisions of DTAA will prevail over 115 BBA or BAA, which is perhaps not something difficult. I wish, which wish has not been granted, is that it should have been given, the benefit should have been given to a new industrial undertaking. If you see 115 BBA, it's all about rate of taxation, but it's mainly because of the production, mainly because of manufacturing, mainly because you are setting up a new company, isn't it, right? No? So if that is so, if I am satisfying all such conditions, why do you want me to constitute a new company? Why do you want me to share a handicap, which requires me to form a new company? Why this is important is that some of the courts have taken a view that if I am funding If I am funding the new company, it would be considered to be a split up. So there is a transition of capital from one company to the new unit, then there is a problem. To do away with this, it would be more appropriate that income which is earned with reference to new industrial undertaking is a concept which is now very well understood by everybody. Then in such case, the income attributable to NIU should be eligible for this 15% rate of tax. If they do so, I will believe that yes, that the manufacturing will really be boosted. Right now, the problem with, whether it's Reliance or Hindustan Lever or Nestle or SR, the issue here is that all of them are cash-rich companies, not SR, but some of them. So they are cash-rich companies, and they if they divert the capital, even by forming a new subsidiary, an issue which will be hanging over their head would be that whether it is split up or reconstruction or not. Many times you share the top management. Now in such case there would be a serious issue that if the same management, same CFO, same CEO, same managing director or the whole-time director is sharing the platform, then there is a problem with this. So the more you apply your mind, the niceties will unfold before you. There is also, when I say that you constitute a subsidiary with the sole purpose of obtaining the concession of 15%, will the provisions of GAR apply to this or not? I would believe that when there is a specific provision, why should GAR be applicable? But the government is always having a different thinking. So please keep that in also mind. It should not be so obvious that everything is doctored or monitored, with the sole objective of claiming the concession. That if there are other provisions where under my concession I am entitled to, I would unabashedly say that I would be entitled to those lower rate of taxation, whether they are part of chapter 12 or anywhere else. Anywhere else, if there is a lower rate of taxation, how could it be taken away? That benefit cannot be taken away. So keep that in mind. Yeah. Consequential impact initially on revenue loss I have discussed with you. Destination is India. Yes, that the whole thing is programmed, with the, objective that overseas companies take the maximum benefit by registering themselves in India and manufacturing, producing and distributing production in India. Relevant for advanced tax and TDS retroactive effect I have already discussed with you. Duration of ordinance is 6 months. We have discussed how it could be overcome. We have discussed specified domestic transactions and all transfer pricing provisions will have to be taken care. That is because the provisions are deactivated presently in respect of the local companies. Once they are activated, the right view would be that all other provisions also of the relevant chapter should apply. Please take that in mind. Complementary amendment is been made in BA, which is why corrigendum had to be issued, because there was a slip that you can transit from BA to BBA, which was wrong. Now you can transit from BA to BAA, which is permitted. Higher rate of depreciation, which is outside this, which is provided for new purchases which you make, because it is believed that auto industry was under a serious slowdown. That was so hyped that when I was in the month of October, I felt that these auto industries companies will be doomed. Now in November, nobody talks about slowdown in auto industry. So therefore, these are periodic slowdowns or hyped media-driven slowdowns. I do not know. But there is a special concession which is given. If you purchase these vehicles up to 31st March 2020, you will be entitled to higher rate of depreciation. MAT, I said, yes, that MAT will not be levied for two companies. An important amendment for all of us is that the rate of MAT is reduced from 18.5% to 15% with effect from 2021. Then this two important things come around MAT is that whether I would be entitled to MAT credit or not. And the circular says that MAT credit would not be entitled. I would take a different view, independent of the circular, that as long as the provisions of 115 JJAA are there on the text, as long as MAT credit otherwise is permissible, then as against the tax which I am required to pay, even though at concessional rate, for that year you are right that MAT is not payable at all. But the MAT which I have paid up to AY 1920, why should it be taken away? Simply because for 2021 you are not making me liable to MAT. A child knows that yes, that a MAT credit is possible only in the year when I pay regular taxes. So if I am paying regular taxes, that is BA, BAA and BBA, all are the cases of regular taxes. And if that is so, why should the credit under JAA is not permitted? Circular is reading the law in a crooked way, with respect I am saying is, and there is another view possible. There is another view possible unless you amend the law, which is possible, and that could also happen with retrospective effect. As the things stand today, I have advised clients, for the purposes of payment of advance tax, to take the MAT credit, and I hope that I am not proved to be wrong. But there is a controversy which is there, which you may keep it in mind. Then buyback of shares, the important amendment which is made is, there was a lot of hue and cry that the buyback taxation which the companies are exposed to, should at least be not applicable in respect of listed companies who had already carried out the process and announced to the stock exchange, which is known as a grandfathering. So the government has considered and accepted this concession by stating that in respect of those listed companies which had made the announcement of buyback, in such cases the companies would not be paying the taxes at the rate of 20%, which is prescribed under a special chapter, but it would be the shareholders, if they are otherwise liable, would be paying the taxes. So the effect now which is unfolding here is that if you would see that you have three different kinds of tariffs, 25%, 22%, 15%. These are special rates. And if you are none of these, then there is 25% or 30%. So there are 5 levels of taxation. You choose one which is applicable to you. 5 different levels of taxation which is applicable. This is only about domestic companies. For other companies, what would be it? I don't know. So this is, as far as individual is concerned, I have singled out individuals for the reason that there is lot of confusion as regards surcharge is concerned. And therefore, this is just that ordinary citizen, this senior citizen and the super senior citizen. I have just placed before you what are the basic rates of taxation. Kindly go through that. Then when it comes to surcharge, the important things which have happened in between, the Finance Act or through Finance Act or through the Ordinance. So what is that we shall understand. That as far as domestic company is concerned, the Ordinance specifically provides for surcharge of 10%, and this is flat. This is not 7%, this is not 12%, this is not 0% as well. 1 crore 0%, 1 crore to 10 crores 7%, above 10 crores 12%, all companies. But if you are a domestic company, it is flat 10%. If you are a domestic company which is set up after 110, on or after 110, and which is also manufacturing, then also flat 10%. So keep that in mind. So this is for companies. When it comes to individual, the whole show is like a horror show. Very difficult to understand. I'll just rush you through that. Is that the Finance Act provided for increase in surcharge in cases of individual, HUF, BOI and AOP or the juridical person. It provided for an increase from 10% or 15% which was otherwise payable up to AY 1920. In cases where your income exceeded 2 crores for individuals, your surcharge would be jacked up from 15% to 25%? From 10% to 25%, right? No, I said 15 for the reason that 15 is now a flat rate. 15 is a flat rate, but you are right that from 10% it is jacked up to what? 25%, right? And if your income exceeds that 10 crores of rupees, it will go to 37%. And normal individuals did not have an issue, but the FIIs have the issue because they were classified for the purposes of taxation either as an AOPs or BOIs or an individuals. And in order to cater to this special class of people who has the capacity to make their voice audible, to make their voice heard, a concession has been given now to provide that in case if you happen to be one of the classified entities, which includes individual, HUF, AOPs, BOI and the juridical person, and if your income happens to be derived from the short-term capital gain or the long-term capital gain which is attributed to the equity shares or the units of EOF or the units of business trust, or you are covered by 115 AD, then in such case, and when you are covered by AD, it would include income from derivatives also. So the comprehensive understanding of this is that in such cases you would be not liable to pay surcharge at the elevated rates, but you would still pay surcharge at the rate of 15%. You would still pay surcharge at the rate of 15%. And it is being provided that for the purposes of computing the limits of 50 lakhs or 2 crores or more than that, the income which is derived from capital gains would be included for the purposes of computing whether you are liable to pay taxes at the higher rate. The last thing we need to know about it is this noise is all about specified income. This concession is also all about specified income. People like us who derive income from honest activity or providing services, we don't get any concession. We will pay this surcharge at the rate of 25% or 37%, provided assuming that we earn this kind of income. Yeah. So therefore, the final rate position would be like this, which is, so this is the final for domestic companies. That MAT finally is 15%, and then I have placed all this is. So your tax rate in these 5 different categories, B, C, D, E, F, would be minimum 26%, 17.16%, and it could be as high as 35%, 34.94%. This is the savings which you have made. This also is played. I am repeating that the benefits are handsome. Please look into them. And this is something I may be pardoned for not having considered. There are 6 major amendments which have happened between the Finance Bill and Finance Act. All of you may be conscious of this. Please look into this because the time is running out, and I'll take your permission to sit down. Thank you so much.